In this short video, I'm going to explain the basics of what ETF fees are, when you pay them, how you pay them. I'm going to talk about the taxes associated with ETF investments in Australia, when you pay your taxes and how you pay it. And I'm also going to talk about something called spreads, which is another thing that investors tend to think about but don't really understand what's going on. So let's talk about ETF fees. In Australia, almost every ETF, at least every ETF that I can think of, has something called a management fee. So when you look at a management fee, it's important to remember that this fee is deducted from your investments automatically, and it's typically taken out every day. So for example, if you invest in an ETF that has a management fee of 0.5% per year, or 50 basis points in financial jargon, what that means is the ETF issuer, so like Vanguard, Beta Shares, ETF Securities, whoever it is, they're taking out that 0.5% per annum in a tiny little amount every single day. So that's typically how fees work when you invest in an ETF. However, it's important to consider that there are at times other fees that get incorporated into that. So it can deviate slightly from what you see in the PDS or product disclosure statement. Sometimes it can be, instead of 0.5%, it might be 0.51 or 0.52%, depending on the year when the fee was actually recorded. Now, the other thing to keep in mind is that the fee for ETF investing is separate from your brokerage fee. So when you actually buy and sell an ETF, you typically pay a fee each and every time you do that. And that might be, say, $10 for an investment of $1,000 into an ETF. And so some brokers in Australia have made this really low cost. In fact, some of them have made it free for certain ETFs. So that fee actually goes to your broker, not to the ETF provider. And obviously, with both of these fees, you want to try and minimize fees to the extent that you don't, give up any good investing. So some people think that the lowest fee equals the best investment, and that's not always the case. The reason that fees are important and the reason that fees are important to keep low is not for returns from any one year to the next. It's actually for your returns and the value of your investment over very long periods of time, because they're like termites. Eventually, they take down, your returns, but at first you don't really notice them. So fees are important, but don't necessarily think that the low fee equals the best investment that you can make at any one time. The second subject that we're talking about is tax on ETFs. So the way tax works on ETFs can actually get quite complicated. So I want you just to imagine it's like a normal investment. A normal investment into, say, a share, like an individual share. Typically what happens when you buy an ETF is you're buying it, there's the ETF in the middle, and then there's whatever that ETF is investing in over here. The way it works is it's just like as if this thing wasn't here. What do you own, and how is the tax similar to what you would normally pay if you own that investment directly? The only difference is we have an ETF here, and that ETF can, at times, own thousands of different investments. So you own a tiny little piece of every one of those investments. And so if the ETF decides to buy or sell a particular investment inside its portfolio, eventually that change, whatever that change may be, if it's a capital gain or if it's a dividend that's paid to the ETF, will come back to you as taxable income or as a capital gain that you will have to record on your tax return every year. To make things really simple, what the ETF providers do, so again, I'm talking about organizations like Vanguard, BlackRock, Spider, talking about Beta Shares, ETF Securities, all of those different providers. What they do is they typically issue a tax guide every year. So the tax guide takes you through where on your tax return you need to put all those different things. So where you put the income from distributions, where you put the income from any foreign investments that the ETF might make. So if it's a global ETF and it's investing overseas, that income might be different to if it invests in Australian investments. And so the ETF providers issue these guides that show you where you put that on your tax return if you're doing it yourself. Otherwise, what you do is every year, these ETF providers will again issue you a document. And this document is called basically a member statement. And what it does is it shows you, it itemizes all of the different types of, distributions or gains that you've made throughout the year. Remember, it might be a very small number because you may own small bits of lots of different investments inside the ETF. So for example, if you have investments with Vanguard, BetaShares, Spider, and ETF Securities, so you own ETFs from all of these different providers, they will all send you a tax statement. And you will need to look at what's in that tax statement for all 4 of them and then match them up when you do your tax return. And you can typically expect to receive that just after the financial year. Now, there are some nitty-gritty details here which your accountant should be able to provide some clarity on. But basically, what happens is what you actually receive in your bank account every year as a distribution or a dividend may not be exactly what you have to record on your annual tax return. So it's important to read that document before you file your tax return for June 30th. So remember, just in summary there, you're going to pay taxes just like you would if you had a normal investment. So you'll pay taxes on any distributions, which are like dividends, and you'll pay taxes on any capital gains that you make. So when you buy and sell the ETF, you may have to record a capital gain for whatever you've made on that ETF investment. For example, if it goes up in price, say from $10 to $12, and you sell at $12, there's a capital gain that you have to record on your tax return. But it's everything that goes on inside the ETF is reported to you by the ETF provider, assuming that you have, as always, recorded your tax file number and you've registered with the share registry. The final thing that I'm going to talk about is ETF spreads. So what are ETF spreads? Now, this is something that sometimes goes unnoticed. In the past, we've called this the silent killer because people don't necessarily understand what it is and how you can kind of minimize it. So when you buy and sell an ETF in your brokerage account, let's say you're trying to buy XYZ ETF and you see the price, it might be $10. Okay, I can buy that ETF for $10 per ETF unit, right? But the last market price, so the last price that you see, it says last traded at, and it might say $9.80. So $9.80 is the current market price. But then $10 is what they're saying you can buy it for because that's where a seller is. That means there's a 20-cent gap, right? Between $9.80 and $10. There's a little gap there. And that is what we call a spread. It's the difference between basically what you're forced to pay and what the current market price is. So we have those spreads on either side. So we call them buy-sell spreads. So the spread is the distance between the buyers and the sellers, basically. And what happens inside an ETF is you don't notice it because you just set your order at $10 because you're happy to pay $10. And you don't notice that you've actually crossed the spread to get into that. But what is really important to note about this is that the bigger an ETF is, the more established it is, typically the lower the spread. So typically, not always, but typically. So that's why some investors say, go with something that's big and established, because then you have a lower spread. Every month, the ASX issues a report called the ETP Listed Products Report. And in there, it's a PDF or an Excel document. It actually shows you what the buy-sell spread is. You can also find that on the Best ETFs website. And so what it shows you is basically what you're paying away to get in and out of an ETF. Remember this though, that during times of market distress, so when the market's falling quickly or rising quickly, or when the ETFs invest in something that's a little bit unique, like some sort of weird commodity, what tends to happen is the spread tends to dislocate. So what I mean by that is the distance between it can get a little bit bigger than what you'd normally see. So during times of market dislocation or market crashes, typically the buy-sell spread gets thrown out a bit. And that actually is a normal function of ETF investing. But it actually is important to monitor because you don't want to be paying too much for something that's only should be priced at this much. So always monitor when you're placing your trades, what the buyers and sellers are doing when you set your order, and you can set your order with a limit price so you know exactly what you're paying for an ETF. There are many other risks, and I've given you the basics of ETF fees, ETF taxes, and spreads. But there are many things that you should consider. Obviously, the best thing you can do is talk to your accountant before you file your tax return. Ask them what you need to do. Reach out to the share registries, so websites like Link Market Services or Computershare to find out what you need to do. Your broker can also have information on what you need to do. And also, make sure that you're really mindful of how you place your trades how much you're paying for that ETF, and whether it's the best type of ETF for what you're actually trying to invest in for the long term. So those are the three kind of nitty-gritty, often boring things that no one really takes any notice of. But I hope that cleared things up for you. Thanks for watching this video.